Hi, welcome to the webinar on 5 best sectors for your equity portfolio. This webinar is brought to you by the well followed and well respected financial content site investorsideas.com. I am your editor Arjun Parthsathi speaking, and I will be presenting this webinar today. The webinar on 5 best sectors for your equity portfolio is part of a series of webinars for our subscribers on our theme for the future. The focus of investorsideas.com is on the year 2018, and we have much clarity on our thoughts for 2018. The reason that we are focusing on 2018, that is 5 years away from now, is that there are strong macro trends leading into 2018 that will benefit investors who take the right investment decisions. We have identified the macro trends leading into 2018, and that includes US turning into an oil exporter, US economy leading the world to recovery, Indian economy bottoming out in the next couple of years, interest rates coming off in the country, and commodity prices staying weak globally on China trend growth slowdown. We have put out a series of reports on 2018, including the best sectors and analysis of a few good 2018 stocks. We have also done a couple of webinars on the 2018 theme. Our focus is so strong on the future that we have modified our subscription plans to help subscribers benefit from our analysis. InvestorsIdeas.com is not a short term thinker, we are long term thinkers, and that is what will benefit our subscribers. Our subscription plans now have 1, 2, and 3 year maturity. All subscription plans gives you access to all the content in the site, more than 1000 reports and analysis on markets, investments, and personal finance. You also get to interact with me and my team of analysts for any queries you may have on markets, fundamentals, and investments. We will be there with you when markets are up and down, and that is what is most important to our subscribers. I will now get on with the webinar presentation. The 5 best sectors for your portfolio. The 5 best sectors for your portfolio are export driven sectors, financial services, downstream oil and gas, FMCG pharma, and entertainment, travel, and tourism. Why have we listed these 5 sectors and not other sectors such as capital goods, infrastructure, and telecom? The reason is that given the macroeconomic factors going into 2018, such as US economy leading the world to recovery, US oil self sufficiency, India interest rates coming off, and Indian economy bottoming out before growing, we believe that the sectors listed above are the best to perform in the economic environment. One common criteria we have for our sector and stock selection is global competitiveness. IT, auto ancillaries, financial services, FMCG, and pharma are all globally competitive sectors. Downstream oil and gas will benefit from availability of gas and oil given US turning an exporter, as well as government policies turning in favor of the distributors. Indian consumers will be active given that consumer trends are changing as the country adds more and more into its middle class. So let us take each sector by turn. The IT and auto ancillary sector. IT exports of USD 56 billion is predominantly to the US that accounts for 62% of exports. US growth and weak INR will benefit IT service companies. Our top picks in IT services are Infosys and Infotech Enterprises. Auto ancillary sector is export driven and are world class given that they face global competition. Auto ancillary sector will benefit from a recovery in the US automobile sector. Our top pick in auto ancillary is Bharat Forge. Our one pick in the OEM is Tata Motors, as we see the company as a JLR stock rather than Tata Motors India. JLR is globally competitive, uses best in class technology, and is present across the world. A truly world class company. Near term volatility can be high on the stock, but for long term, it will give a good exposure to global markets for your portfolio. This is a chart on the sector performances. The financial services sector. The financial sector will benefit from rates coming off on the back of a weakening economy. Lower interest rates will feed into consumer lending as the retail consumers borrows to spend on various goods and services. Investment demand will take a while to pick up given capacity overhang and weak business confidence. Lower interest rates will also boost treasury income where treasuries are active in the markets. Downstream oil and gas. The government has allowed oil companies to pass through oil prices to the end user. The rationalization of LPG subsidies is also positive for OMCs. Refiners such as BPCL are trading at very low valuations at just 0.1 time market cap to sales. While the government is not shareholder friendly, an improving fuel policy will help OMCs to improve valuations. The gas distribution companies such as Indraprastha Gas and Gujarat Gas that deliver gas to retail and industrial and commercial users will benefit from higher availability of gas given global and domestic increase in gas supply. Such companies have capital consumption and infrastructure is difficult to replicate for new entrants. Our top picks here is Indraprastha Gas, FMCG and Pharma. FMCG sector has outperformed by a wide margin over the last 5 years. FMCG companies are well managed, cash rich, and generate strong returns on capital. However, many companies such as HUL, ITC, GSK Consumer, Nestle, and others are trading at high valuations of well over 30 times earnings. Will these companies outperform going forward? Consumer good companies will show growth in the coming years as trend changes in lifestyle helps them. One can look at strong stocks for a portfolio. The stocks in our model portfolio are GSK Consumer and Dabur. Pharma stocks will benefit from US and other global markets as drugs come off patent in the US. One should be selective on pharma as issues of poor manufacturing facilities and issues of leverage and poor management practices abound. The well-run pharma stocks such as Sun are expensive at 30 times over 30 times earnings. Our top pick in pharma is Cadila. Entertainment stocks, including media stocks, benefit from a wide audience. The issue with media is that valuations are not dependent on factors such as profitability, management competence, etc. It is difficult to value media stocks as many of them trade on more M&A perspective. Digitization can help increase revenues for media stocks. Our pick in media are Z Entertainment and NDTV. The weak INR will bring in more USD spending tourists into this country and could turn fortunes for hotel stocks. We are analyzing the sector for good stocks. Margins of sectors as seen in the slide show that IT, financial services, FMCG and pharma have good margins, while downstream oil and gas, entertainment, travel and tourism, auto ancillaries have low margins, and these margins could rise as prospects improve for these sectors. Financial sector is the most heavily weighted in the BSE 500 index, followed by FMCG, oil and gas and IT. If such sectors are looking good, then being overweight these sectors relative to the index will help the portfolio beat the market. These are subscription plans. The 1, 2, and 3 year subscription plans, which gives access to all content in investorsideas.com and interaction with editor and analysts. You can contact Neelima at investorsideas.com for subscription. Thank you very much.